Welcome everybody. This week is talking to a script that I've written beforehand and seeing how this turns out in terms of time. Previously last week I spoke to 5 bullet points but spoke to them on the spot. I've calculated the words per minute and my script is 800 words, so hopefully this will be a 10-minute video, so we shall see. So I'm literally just reading this from a Word document and I'm recording from my laptop and I can't even see the recording of the video. Usually I will be able to see myself. So I'm not even going to be looking at the lens really. I'm just going to be talking to the script and seeing in terms of time, if I talk to a script, how much better it is with the structuring of my words, and also the fact that if I talk to a script, if I'm able to control the time a little bit better. So the last 5 points, the last week we talked about 5 points to do with stocks. That was long-term investing as opposed to day trading. We talked about beta, we talked about discounted cash flows, talked about ETFs, and we talked about money flow. So now I've written these in a script format. I've got 1,108 words that I've written up, and each probably have about 200 each bullet point. So I'm just going to be reading these and seeing how it works out in terms of the time. Okay, so for long-term investing / day trading, we talked about last week how so long-term is always going to win in terms of day trading and long-term investing. So both long-term investing and day trading can provide opportunities to make profit. There's no question about that. The question arises though when day traders try to trade their positions day in, day out. And obviously every day the market will go up, and generally this happens when the markets go down. Liquidity gets pulled out of the market and volume dries up. Liquidity and volume are fundamental tools for price action. So if a day trader were to get into a position, the movements may not be significant enough to profit from those differences in prices. This is as opposed to buy and hold, where you can really notice the difference between what works and what doesn't, is where the day traders trade the stock going up. The trouble with this is that it's twofold. It requires you to simultaneously sell your position and enter back into it the following day, or even the same day, with the same dollar amount injection. If this isn't done, you generally miss the boat of having more returns, unless of course it goes down. But that's what brings me to my next point. If you hold the stock while it goes up, you keep the number of shares you have, which is critical in making big returns that say like 3x, 5x, and sometimes 10x, due to the compounding effects that you really notice if you have a stock that 3x's, say. Because your gains tend to magnify in the later stage in which you purchase the stock. So for instance, if you bought a stock at 10 cents and another at 11 cents, when the stock is at 40 cents, you've gone up 300% in the first instance. But then in the second instance, you've only gone up 263. So if you traded that, you would have missed out on, say, 37%. So that's pretty significant. The bigger the return. My personal opinion on this is that if you're going to trade, you should swing trade. And these involve being in positions for longer than a couple of months. You should use these trades with MACD and RSI. So that's the moving average convergence divergence and the relative strength index. You should always use the standard calculations that they use in it, but you should always use a stop loss at your hurdle rate by the number of years. So Kathy Wood who runs ARK Inverse uses a hurdle rate of 20% per annum. The hurdle rate is basically just a rate of growth per annum that you should expect to see in a stock. 20% is pretty high, but if you got a high growth stock that you think could double within the next 5 years, well, then it's got to have a hurdle rate of 20% per annum. So you want to make sure that when you're trying to get into the stock, that your execution risk is actually limited as well. So you can't just be buying at the top of the stock and say at its year high, because obviously if you're buying at the year high, then it's going to have to push even higher and make new gains. So you probably should discount cost average and sort of get into a stock position where you're not buying at the top, so that 20% per annum becomes relatively easier to attain throughout the year. There's something to be noticed about with the amount of time decay to this and whether full position should be materialized or rebalanced. This year has been quite different in that certain assets have not been negatively correlated to stocks. Otherwise, this would have been the most suitable way to trade the market. As the MACD crosses over, you find another asset class that is negatively correlated to the stock and make the rotation play. So basically, if you're into a high growth stock, so you're into Tesla, and it goes up, and then it's the RSI signal is showing that it's overbought, what you could do is sell the stock and find a negatively correlated asset. So normally gold is a safe haven asset, and growth stocks are a risk on play. So technically they're negatively correlated because you're two different types of risk. So you could take money out of one, put it into the negatively correlated asset, and make the rotation play. That's probably the best way to trade, and that still requires a time frame of two to 3 months, maybe even 1.5 months. Just depends on how fast that changes in the stock, because it can move pretty high, but then the downside will be pretty fast as well. So over the year, the stock might trend 20%, but throughout the year, up 2 or 3 months, you might see it gyrate between 10 and 20%. But overall, it will exceed 20% probably. Okay, so now let's talk about beta. So beta is a measure of a stock's volatility against a security or asset class. This can be useful measure to know. Great stocks trend in the 1 to 2 beta range, with a higher beta indicating that the stock is more likely to perform. Personally, beta is only useful in positions that you're swing trading. And so it's something you could use to measure its overall strength compared to securities. I use beta to compare it to Amazon, Apple, S&P 500, NASDAQ 100, and see how it compares to another security. Usually if the stock has a high beta, it will have more potential or bigger gains. So if you look at any high growth stock, it will always have a high beta of 2 or 1.99 is Tesla's. I think Shopify is 3 almost. So these are all stocks with high betas and have huge, massive growth to the upside. But then, of course, like if you're trying to set up your trade 3 years down the track, and it's not producing anything right now, but down in 3 years' time, it's probably won't going to trend in that 2 to 3 range, or even above 1.5. The beta, you can really tell if a stock is going to push really high soon, using the beta, but it doesn't really apply to 3 to 4 years out. So the next thing is discounted cash flows. Like I've stated in the previous video, it's a financial model in which you predict future cash flows of the business to get an enterprise value. The enterprise value then can be divided by the number of outstanding shares to arrive at a price per share basis. If the current price of the stock is below the DCF model price, it may be a good opportunity to invest. This model is extremely useful and is used by all financial institutions around the world. While many financial analysts use DCF models, there are huge discrepancies because of the inputs plugged into the model. This is where one could say the money is made. If you know revenues coming into the business are going to be exponential, you can forecast that into the model such that the DCF model price will show a figure well above the model that has forecasted linear revenue growth. So basically, if you have a business that you know is going to, if you have inside information, say, and you choose to act on that inside information, you know that a company is going to get several contracts with big firms, but the market's probably only pricing in the current contracts. Well, then you know that revenue is going to be put into the discounted cash flow model, which then will raise the valuation of the company. So the fourth point was ETFs. While Warren Buffett has said investing in an S&P ETF is the best way for an investor to invest in the stock market, ETFs are extremely diversified. When you know about businesses and how to value them, ETFs are detrimental to your portfolio because you're essentially taking out all the averages of your holdings. And so while you might have outperforming stocks, you'll never get an outstanding return because the stocks that are lagging will sort of average out the returns, and so your average return will be much lower because of the laggers. And so it's very rare that you have a lot of winners, but it can be quite common where you don't have stocks that are lagging and also that are doing relatively okay somewhat, but definitely not as great as your winners. And so if you have 3 winners but you have 10 or 20 okay gains, then it will average out and your returns will be far less than if you just poured it into the top 3 performing stocks. So this is why I suggested in my previous video that you should invest in the top 3 outperforming stocks, and therefore you're sort of diversifying by hedging your risk. And so the final point was money flow. You can think of money flow as directly related to the amount of money in the system and where that money is shifting. So be it from one country to another, one asset class to another asset class, or one stock to another stock, it's important to observe these changes in money flow because it can give you an indication of where the stocks are moving. From a country standpoint, you will often see a huge money outflows in a country where there are political risk, and even worse, there's political unrest. This trickles into the stock market where money flows out of the country, so people liquidate stock positions and get out. And we've seen this in crippled Colombia and Hong Kong most notably. An asset class is something also that you should be observing the money flow. This is effective because you'll be able to identify money moving out of the stock market into, say, like something like bonds or gold, and you'll be able to anticipate those changes. And there is actual websites out there that track the money flow. So if you look at the daily money flow of asset classes, then you can see where there is actually money pouring out. but not necessarily stock prices are going down. It just means that liquidity is being pulled out of the system. When there's money being pulled out of the system, but the stock prices stay high, eventually you'll find no buyers and the stock will then eventually fall, because then there's no liquidity in the system. It's all out in bonds and gold. From an asset class point of view, from an stock point of view, it's relatively the same. You'll often see money flowing out of growth stocks and into value stocks. Say when the word inflation is mentioned, you probably see a lot of money flowing out from a high growth stock because of lifting interest rates, which lowers the price in the discounted cash flow model. And so you might then see it rotate into value stocks, because those things don't need a lot of debt to fund the company. They are on free cash flow and they can sustain in a predictable manner. And so that's all I've had to talk about this week. So this week's total script had 1,108 words. So I'll just review this video and see how I do time-wise. I have a feeling I did say I wasn't sticking to the script, and I did go on a bit in a few other points. So I wasn't totally on the script. I have a feeling it might be 12 minutes or something. We'll see how it goes. I'm going to calculate the words per minute and check my cadence, and because that's basically what I'm making these videos for. And so I will check back and then see if I need to work on anything the next week. So thanks for that. Thanks for watching, and I'll see you next week.